Good evening, everyone. Thanks for joining on the weekend, and I'll make sure next 1 hour we will add value to your trading profession, to your trading which you're going to take in future. So let me just give a quick reminder on what we discussed last week, and then I'll share the new strategies for this week. So before that, all right, if some of you are new to our channel, if you are new to uh, first time attending the session, basically we have uh, a big team of analysts where we provide education trainings on stocks, ETFs, options, futures, and crypto in both US and India. And we have alert services in US and India where we give alerts for all these various securities. We are planning to resume our mirror trading. We had some technical glitches in the beginning of year, see to fix some of the issues. We are continuing to test it, and once everything is stable, we are planning to resume the mirror trading. And also, if you need service with either will and trust or retirement planning or kids college education planning, or if you want to do real estate investments, or if you need insurance, or if you're looking for business opportunity without investing a lot of money in the financial domain. So there are a lot of, we are like one-stop shop solution for all your financial needs. You don't need to go to 10 different places for anything related to money. We can help you with all those things. In the last week, we discussed right what are earning reports. We discussed that every 3 months, these all these companies, public companies, they need to report how they did in the previous quarter, what are their earnings, what is their earnings per share, what is their guidance for the next 3 months. Because of that, because of those reports, it can act as a strong catalyst. So there will be a lot of interest for the traders, hedge funds, everyone to invest into those companies. So if company gives a good report, then the stocks can huge move 10, 15%, 20%, or if company is giving a bad report, they can also go down. So there will be a lot of liquidity. There will be a lot of interest for the traders in the earnings season. So especially before earnings, all these stocks will keep moving up. So if we buy calls or buy puts based on our assumptions, generally that's what we do, right? We buy if we expect that Apple may give good earnings, or if we expect Netflix we may give something, or Tesla may do something, we buy calls or puts, generally retail traders, right? So we also discussed if we buy right, if we buy generally we do right as retail traders, because generally we have a smaller accounts, we don't have big collaterals to support for right for selling the calls or selling the puts. Generally, many retail as retail traders, we generally buy a call or buy a put. If we think a stock will move up high, right? Either we can buy a stock or we can buy a call. If we buy a stock, you have a low risk, but the problem is you need huge capital, right? Even stock moves by 5% or something, maximum you can gain is 5% by using a big capital, huge capital. Whereas when you use options with a smaller capital, even Tesla or Google or Amazon or whatever it is, even Chipotle, even though it is a $1,500 stock, you may not have huge capital to buy hundreds of those stocks. You may just buy a call option. If you think Chipotle is continuously, it is doing good earnings every quarter. So you can buy a call and you can make money, right? Instead of investing huge capital. So that's why generally, if we are bullish about a stock, bullish means basically you are expecting the stock to go up. You are expecting that company to give some good reports, and then the stock to move up more. Then you buy a call. If you are expecting that company may not do well because of various reasons, then you generally buy a put. So if we are buying a call or put, the problem is if the stock stays at the same price, there is no change in the stock, we generally lose the money. Or if stock only moves a little, right? For example, let us say you bought Moderna stock, right, which is approximately $150 now. If you buy a call for 150 or something by paying $5 for next week expiry, if the stock moves only by $1 or $2, you will still lose, right? Even though stock moves a little, if stock moves a little against you, you will lose. If stock moves a lot in your favor, that means from 150, stock moved to 170 or $180, then you will make profits. If the stock moves a lot against you, again you will lose. So out of 5 possibilities, we the probability is we losing 4 times and only one chance for making money when we buy a call. In the same way, you are bearish about a stock. If you are buying a put, same thing. Out of 5 different chances, there is only one way we can make money. So unless we are very, very certain, unless, right, it is one directional. So unless your expectation goes in the same way, otherwise we cannot make profits just by buying calls or puts in the earning season. Right. Again, I don't want to repeat everything, but we discussed like what is the extrinsic value, because when you are paying a premium for buying a call or put, you are not just paying for the price change, you are also paying for time, right? Theta decay, right? Time value. You are also paying for implied volatility. You are paying for a lot of other things. So even stock moves a little bit, you won't make profits because the other components, they are eating all your premium. So we discussed about what is implied volatility, why the IV component will be very, very huge during earning season, right? 1 week before, if it is 36%, 1 day before, the IV will be approximately 72%. And again, after earnings, the IV will drop to 27%. So because of that implied volatility concept, right? Even though stock moves a little, because you are paying for the IV, because the IV is dropping, because the IV gets crushed after the earnings, we generally lose by just buying a call or put. So we discussed all these things. So the most aggressive, if you are a risky trader, you have a big account, you are okay to lose, and you are ready to take that big risk, then you can buy calls and puts. So only one way of making money, right? It is the most risky strategy or most risky way. But if it works correctly, if it goes as per the expectation, we can quickly make good money. The second way is where we can do debit spreads. Instead of completely buying a call, you will buy a call and also you will sell a call. Or you would buy a put, you will also sell a put. So you are reducing your capital by nearly 50 to 60%. The reward also will get reduced, but the risk also gets reduced. So it is moderate strategy. The least risky strategies, credit spreads, where you have high chances of making profits. You can make 85 to 90% of the time, you will be on the profitable side, but the reward will be low, right? We all know that where you have a less risk, the reward also will be less. In a bank, they don't give, they give 0.1%, 0.5% interest per annum. So the risk is low. In crypto or in futures or in options, you have a high chance of making profits, but the risk also will be high. So the credit spreads is where, right? It is much better than a bank. You can make 15%, 20%, 30% profits, but it is not like call or put where suddenly if a stock moves by 20, 30 points, you, let us say you bought a call and, or you bought a put for Meta. Last week we discussed that Meta might do same as Snap, right? If you listen to the recording, we discussed about Meta many times. So for example, if you bought a put for Meta and if it, right, it went down so much, you would have made nearly, by paying up $10, would have turned to $40 or $50, right? But if it doesn't go in the right way, we can completely lose everything to zero. So we have, right, we discussed about credit spreads, and we discussed there are mainly two types: put credit spreads, where you are bullish about a stock, you buy a put credit spread. If you are bearish about a stock, we do a call credit spread. So, right, we already discussed, right, the result by buying calls or puts. In 4 ways you can lose, only one way you can make profit. Whereas here, even though it moves a lot against you, also there is a chance of making, right, nearly 4 to 4.5 times we can make profit by doing credit spreads. We discussed all these things last week. And right, there is another strategy. right? Until we discussed until here, where we discussed about put spreads and call credit spreads. There is one more strategy called as iron condor, right? Where you are not either bullish or you are not either bearish. You are expecting a stock to move sideways. That means it won't move too much up or too much down. You are expecting the stock somewhere in between, right? A minor change up and down, but not a major change. So this is another strategy. For example, Disney. We have earnings of Disney very soon, right? I think 11 or something, right? Disney is a stock which may not move huge, right? It may not move like other stocks. It may not go down so much, or it may not go up also so much. Or you have something like Cisco. That is another stock which will not move so huge, right? It won't go 20% up or 20% down. It will be somewhere sideways. We have Chewy, right? These are some examples. So where, right, in the previous examples, in the spreads, what we did is we just sold a call or sold a put and bought a put. Whereas in the calls, in the credit spread calls, we sold a call and bought a call. Whereas here, you are doing both the things. You are also doing puts, you are also doing calls. So when you take a put credit spread and call credit spread at same time, then if stock is not going so huge, or if stock is not going so much, if it is remaining at sidelines or right nearly at the similar price, then we can make profits. So we need to identify such type of stocks based on previous earning reports, and then we have to look at such type of stocks, and we can make good profits by this is like a neutral strategy. One of them is a bullish strategy, right? This put credit spreads is more like a bullish. You are bullish about a stock. You are bullish about Nvidia, or you are bullish about AMD. You are bullish about right. We took multiple credit spreads last week. So when you are bullish, we generally take a put credit spread. When you are bearish, you take a call credit spread. When you are neutral, when you are like thinking that it won't move so high or it won't move so down, then we generally take the iron condor, which is a combination of a put spread and also a call spread. So this is a neutral strategy. Again, the profits are not huge, but the risk is also very, very low, as long as that stock doesn't move so high or so low. We also discussed about right straddle, where right this is opposite to iron condor, right? Iron condor is where you are thinking that it should remain nearly at similar price, right? Maybe $1 up, $1 down, but it should not be like 10%, 15% up or 15% down. Whereas in straddle, the strategy is where you are thinking that stock can go so up or so down, right? For example, we already discussed this last week, but we discussed that, right, where stocks are like Amazon or Meta or Google or Netflix, Apple. So these stocks got a lot of hype. So if they give good reports, they go so high, or if they give some negative guidance, or if they don't meet the expected, they also can go down so low. For example, we saw how Meta went down, right? So for these type of high hype stocks, we need to buy at the money straddle. What do you mean by at the money? If a stock is at, like, for example, $100, you buy 100 call, you buy 100 put, right? For example, you are putting $5 here, $5 here. And then if stock either goes up, you make money, right? If it goes up by 10, 15%, you make nice profits. You may lose one of the leg, but the other leg will make huge profits. Or even if it goes down, you make huge profits, right? I hope you got the difference between iron condor and straddle. Iron condor is you are expecting the stock to remain in the sidelines, remain at same price. Whereas with the straddle strategy, we are expecting the stock to go so high or so low, 10, 15% down or 10, 15% up. So for example, even Amazon, right? When the earnings were announced, so immediately it went so down. So you can immediately, right? You are buying a straddle and you can lock in the profits by buying or shorting the stocks. For example, right? Because options you cannot do after market, but you can always buy the stocks or short the stocks after the earnings announcement. Let us say Meta got shorted, right? Uh, for example, you bought a straddle for Meta or you bought a straddle for Amazon. When you are buying it and suddenly the price goes down, right? For example, Meta, same thing happened, right? Even Amazon, it went to $87. So you bought one straddle with strike price of $100 for by paying $10 premium. And if stock is moving to $80, you buy 100 shares of that stock. You immediately buy that Amazon stocks at $87 or $90. So next day morning, right? Whatever contracts you have, because you already have those stocks, when those stocks get right, when that option contract get expired, they will use use the stocks in your account, and your contract can get executed. So instead of waiting until next day, because right, as we saw with Amazon or Apple, right, they went down, but next day morning again suddenly they started moving up. So instead of waiting to until the next day morning, until market opens, we can always, after earnings, we can buy or we can short the stocks and we can lock in our profits. So this is another strategy we discussed. So until now, one is put credit spreads, then call credit spreads, then iron condors, then straddle. These are the 4 strategies, good strategies or low risk strategies. So again, straddle is little risky if the stock is staying at same price, right? You bought a call, you are buying a put, but if the stock is staying at the same price, then we will lose. So that's why we need to find the stocks which have huge hype around them, right? For example, CRWD. There is a lot of hype around that stock. So we have earnings coming up soon. Such type of stocks where generally there is a tendency that traders are expecting good earnings or good movement on those things, right? If they give good news, stock also can move huge. If they give bad news, or even if they don't meet the expectation, even though they meet EPS, other things, if they don't have proper guidance, they can go down huge. So this straddle is also another nice strategy which we can use. But in addition to this, I have another 2 great strategies which are very low risk for the earnings play. So again, these are some of the credit spreads we took last week. So most of them, we have nearly 90% success. Whatever we have taken, right? We took the Neo credit spread, MA credit, right? We basically put credit spread is also called as bull put, because we are bullish on the stock. We are bullish on MA. We are bullish on Coin. We were bullish on Guild, Airbnb, AMD, PayPal, Google, right? Just we made mistake with V. Again, it was in profits, but we did not book profits on time. Then it moved so huge on Friday. Then CAT, we were bullish. So most of the stocks we were bullish, and all of them moved well. Amazon also we were bullish. It is an unrealized loss as of now, but we know that stock is moving well, and this also will become profit. So nearly 90% of the trades we took on credit spreads. We did not take straddle because it was little risky. The premiums were high, but all the credit spreads we took, we made 90% of the profits in the last week. Then, the other 2 strategies which I wanted to explain, one is cash secured puts. What do you mean by cash secured puts, right? Even if you are a stock buyer, even though you don't want to do options or something, it is also very important for each of you. So let us discuss about what are these short puts, right? Or what are these cash secured puts? Let us say, when Amazon went to $90 or $100, that's a great price, because we know Amazon, right? It is a global company, worldwide company. There is no change in the fundamentals. So definitely stock will, if not today, maybe by next year, it may go to $200 again. So instead of buying that stock at $100, what you can do is you can sell a put. When you are buying a stock, you can also sell a put, right? Instead of buying the stock, you can sell a put and collect some credit, collect some cash. So again, think about this example of insurance agency, right? We are paying our car insurance, we are paying our health insurance. So if 100 people are paying for car insurance, how many people generally, right, applies for the or do the claim and get some benefits from the insurance company? There might be only 3 to 4% of the people who may really take the benefits by for the insurance which they are paying. Other 96% or generally because we want to mitigate the risk, we are paying it. If nothing may happen to that 96%, only that 3 to 4%, something, if something happens to them. In the same way, in a contract, in an option contract also, you have buyers, you have sellers. Somebody is buying a put contract, that means I am bearish, or it is just like buying an insurance. I am assuming that that stock might go down, right? Just like you are assuming that your car might go down, your car may have some issues, you are buying an insurance. In the same way, in options also, we are buying a put because we are assuming that stock will go down. If the stock goes down, you will make profits. If stock stays at same price, or if stock moves up, then the seller of that premium is basically at a profit. That means seller is always got a higher probability. So which side you want to be? Do you want to be a buyer? Do you want to be an insurance company, or you want to be a person who is paying the insurance? Right? It is up to you. You have both the options. But as a buyer, you have only one way to make money. But as a seller of the puts, they can make money in multiple ways, right? As I explained you in this slide, there are so many different ways. Even if stock stays at the same price, he can make money. If the stock moves a little in the buyer's favor, he can make money. If stock moves a little against the buyers, the insurance company will make money. Like that, there are 4 to 4.5 ways the insurance company can make money, or the seller of the option contract can make money. So this concept is same, like instead of you being a person paying the insurance, you can be the insurance company and you can sell the puts, right? Why do we need to sell the puts? By selling the put, basically you are collecting a premium, just like the insurance company is collecting some money from us every month, right? So that what they are saying, if something happens to your car, we will pay the damages. We will replace the car. If it completely goes down, if you get into some accident, and if it happens completely, it is damaged, we will replace it. So that's what they are collecting the premiums. In the same way, in the option contract also, the seller of the contract is collecting the premiums and telling that if the stock goes down by so and so percent, based on whatever put you are, right? You may take an insurance policy, right? Car insurance for 500K, 300K, 1 million, whatever. Based on whatever you are taking, in the same way, in the option contract also, you may take for a certain strike price. Let us say Amazon, you are buying a 90 put and you are paying some premium. Then the seller is obligated to buy the stocks at $90 from this person. Even though Amazon goes to 70 or 80 or 60, the seller is obligated to buy the stocks at that particular price. So by selling a put, you need to understand you are the insurance company now. So by selling a put, you are obligated to purchase the shares at a specific stock price. So for example, now you want to, let us say, SOXL, right? Very good ETF, which was around $60 to $70 last year, now trading around $7 to $8 or $9, right? It is ranging between that $7 to $9, right? It is a ETF, so the risk is very low, right? You don't need to worry that suddenly how this becomes zero, right? ETF means it is a combination of multiple stocks, right? It is not just one stock. If it is one stock, you may have some problem that, oh, if something happens to the CEO, the stock price can go down or something. But as an ETF, the risk is very low. So now let us say you want to buy SYXL stocks. instead of directly buying the stock, what you can do is, for example, now SYXL is at $8. What you can do, you can sell a put for $6 or something. That means you are telling to the buyer that if SYXL goes to $6, I will buy the stocks at $6 from you or $7 from you. Anyway, you want to buy at $8 now, right? Because you know that it is a very good price for SYXL. Instead of buying at $8, what you are doing is you are collecting the credit from the buyer for 7. You are saying that even though SYXL goes to 6 also, I am ready to buy the stocks from you. So that's what you basically, and you collect a premium. So let's take some examples, right? Let me show you some examples so that it might make much clear for you. Or let us take example of CVN itself, right? Again, Carvana is one good company, which was like around $40 or something, right? Right, you can buy cars, everything online. You can design a, so it is one of the companies. They don't have many competitors in this area, in this market. So it is a good company, and they have earnings, right? If you see CVNA, their earnings are in next 3 or 4 days. And generally, we know that before earnings, there will be always good demand for those companies, and they will move high, right? Before the earnings. After once that earnings call is done, either they can move more or they can come down. But 1 week before, 2 weeks before, there will be always good demand for the stocks and also for the option calls. There will be always a demand. So now let us say I want to buy some 100 stocks of CVNA because it was $40, $50 last year. And I know that if market moves, right, becomes positive or moves, then this stock can again go to $25, $30. So now, right, I want to buy stocks, right? If you see CVNA chart, right, you can see that on a daily chart. Right, it was sometime around, it was $309, right? I don't know if there was a split or something, but Carvana was trading at $309 some time back, and now it is at around $12, $13, right? Even with split also, it is at a very good discounted price. And earnings are happening in, I think, CVNA earnings. If you click here, you can see that the earning conference call is on November 4th. So generally, right, the possibility of the stock to move high. So one thing is I can just buy the stocks, right? And I can wait, I can sell them. That is one way. Or now the stock is around $14.5 or something, right? On Friday, it got closed at 14.49. What I can do, instead of me directly buying the stock at 14.49, 14.5, what I did, basically, I am selling a put, right? I am selling a 12 put for December 2nd, and I am collecting approximately $1.6, $1.7. So what I am telling to the buyer, so somebody is buying from me. If there is if I am able to sell, that means there are some people who are expecting that this stock to go down. So they are buying it. So I sold this and I collected $1.6 or $1.7 as a credit. That means I collected. So what the brokerage platform will do, because now you have an obligation. right? You are collecting the premiums, right? You are becoming the insurance company. So the brokerage company will hold, for example, if I am buying one contract, that means, right, what I am agreeing, I am saying that even though this stock goes to $10 or $9 or $8, I will buy the stock at $12 from you. That's what I am committing to the buyer. He is paying this premium to me. That means 1.6 means $160 for every contract. If I get it, if he is buying 10 contracts, I am collecting $1,600. If he is buying one contract, I am taking $160 from him. And I am giving a commitment to him saying that even if stock goes down to any extent, I am ready to buy it $12 from you. Right? I hope that is clear for everyone. If you have any questions, put it in the chat window. Right? So basically, as a seller of a put option, I have an obligation to buy the stocks at $12. But because the earnings are there, because it is a good stock, and I am planning to buy the stock anyway. So this is a stock which I want to buy. But instead of directly buying, what I am doing, I am telling that I will, right, if it stock goes down, I will buy it at $12. Right, whatever stocks you have, I am okay to buy at $12. I am collecting the credit. So let us say before earnings, what is the possibility of the stock to move up or move down before the earnings? Right, forget the earnings are on November 4th. But until November 4th, generally the chances of stock moving up is high. Any stock, right? After earnings, if they announce good earnings, it can move more high. Otherwise, it can come down. So we are using that opportunity and we are selling a put contract. We are, right? The brokerage platform is keeping some of that amount, right? 12 means $1,200. They are keeping it as a collateral, that is cash secured. That means they are keeping our $1,200 as a deposit because you are collecting the premium. Suddenly tomorrow, if you close your account and if the stock price goes down, then they won't have the money. So that's why the platform will put a collateral when you are selling a premium. But so what is the, right, what is the break even? If at $12, you are saying I am okay to buy the stock at $12, you are collecting $1.6 premium. That means this stock should go to nearly 10.4 for your break even. If the stock is above 10.4, you are in profit, right? The stock is currently trading at 14.5 and it got a high implied volatility. It can move maximum $4, right? As per the IV, in the next 1 week, it can move $4 here up and down. So from 14.5, even if it goes $4 also, but generally before earnings, it may go to 15 or 15.5. And if the stock value is increasing, this value will decrease. That means you got the premium of 1.6 or 1.7, but as the stock keeps moving up and up till the earnings time, this value will keep going down. That means you collected 1.6. If tomorrow or Monday, Tuesday, if the stock goes up, this value will go down. Again, you can buy back, taking 40%, 50% profit, and or you can wait until the end, because anyway you may want to buy this stock at CVNA. If stock stays above $12, all this money you collected is yours. If the stock stays below 12, even up to 10 point, because you're collecting the credit, so your break even is 12 minus 1.6, whatever premium you collected. If stock goes to only 10.4 or below, you are at a loss. If not, if the stock is staying above that price, you will be all 100% whatever premium you collected. If they bought 10 contracts, all that $1,600 might be yours, right? So again, if you want to wait until earnings, you can wait, or even before earnings, this value goes down by 40-50%, you can take profits, maybe leave one contract or something, and you can make good profits, right? So like this on stocks or on ETFs, you can do it on anything, right? For example, SYXL is approximately $9.5, right? So you also need to see, right? You cannot take some contract where the premiums are very low, right? Because you don't need to unnecessarily uh, block your capital. So you also need to look at which is the best strike, which is the best right best time based on the ETF or stock. You need to see which strike has a better premiums and whether it is bullish. Again, you don't have earnings for the ETFs, so that's why generally for earning season, if you think that this particular stock might move up before earnings, if we can take such type of premiums or such type of if we can sell the puts, right, instead of money sitting in the bank, if you have the same money sitting in the trading account, right, and you are basically, again, don't sell the puts on some right useless stocks or unknown stocks. If a stock anyway you may want to buy it, instead of you buying SYXL for 9.5, you may say that, okay, right, I will sell a put for $8, and you will collect the premiums. If stock goes to $8, then you already got some $36 as a premium. That means your actual value of the stock is becoming only 7.6. Right? Instead of directly buying the stock, you can sell a put, and if stock stays above that price, you got all this money as free. You don't need to buy anything, or you don't need to buy any stocks from that buyer. If stock only goes down below that price, right? For example, if you sold 8 put, and if SOXL is going below that 8, then you may have to buy it. But instead of buying it $8 or $9.5, now you are buying it at only 7.6. And again, within 2-3 days, again you will see a squeeze. Again, it will go to 9.5, $10. Again, there will be a dip. Again, it will go to $7-8. So we know how the market is playing, right? One Monday, Tuesdays, you see a dip. Again, Fridays, there will be a squeeze. So that is what is repeating multiple weeks. So this is the best time, right? One is you can use this market for these type of, right, on TQQ or SOXL. Look for the best strikes where you can collect good premiums, so that instead of buying a stock at a high price, you are already collecting the premiums. If stock doesn't come to that price, all your premium is yours. If stock is going below that, that means you are getting a good ETF or good stock at a discounted price. Right? I hope right you got it, but if not, let me take some more examples. Right? Let us say there is a stock like Amazon trading at $100, right? And you are bullish about the stock, or you are selling a 30-day, that means 30 days from now, end of November, put 90 put for $1 or $2, right? Just for example, you think like $1. That means 90 minus 1, that means this 8,900 will be blocked as a collateral. So if stock stays above 90, then all that money, whatever you collected as a premium, is yours. If stock, right now the stock is trading at 100, from 100, it going to, if it is anything above 90, if it goes up, or even if it goes to 90 also, it is all, whatever premium you collected, it is all your money. Even if it goes to 89, it is all yours. Only when stock goes below 89, there might be, right, you might incur some loss. But again, you don't need to wait until the earnings call and suddenly stock dropping. Before earnings, generally stock will be moving positively, because there is always that interest among the circle, among the traders before the earnings. So that's why before the earnings, if you see any stock, generally they will keep moving up, right? So this is the best time where you can sell the puts and collect the premium. And generally, because stock will be moving positive, your the put value, right? You will be making profits on the puts which you sold. Let me give you some more examples. We saw about CVNA put, right? For example, AFRM. You can when is the earnings for AFRM? For CVNA, 11/3 is the earnings date. So we can sell at 12.5 put, or you can sell at 12 put, right? So from 14.47, which is the current stock price, there is a high IV, implied volatility. So even though the stock stays at the same price, you will make profits. If stock moves up, you will make profits. Stock goes little down, you will make profits. There are so many different ways you can make profit by selling the puts, because they got a huge implied volatility. Right? As I told, before earnings, there will be huge IV. And immediately after the earnings, the IV will get crushed. So as a buyer, you are paying for the IV, for time decay, all these things. As a seller, you are collecting, you are taking advantage. Every day passes, even stock doesn't move, you will be making profits. Stock moves up, you will be making profits. Stock moves little down, you will be making profits. So there are so many ways we can make profit. So these are various examples, right? Right, Friday, there was so much bullish movement. Generally, right, when on a red day, if you do this type of selling of cash secured puts, you can make much more profits, right? Generally, for example, on FOMC, there is a negative news or something. Suddenly, most of the stocks will go down, right? So that is the best time where we can do this type of cash secured puts, because generally once they go down again, next 1 or 2 days, again stocks will start moving up. As stock starts moving up, you will be making more and more profits from the puts you sold, right? But just for example, I am sharing multiple tickers which we can, right? For example, on Monday also we see that market is bullish and market is moving up. Then you can take some of these alerts and you can sell the puts. So AFRM, another stock whose earning is on 11/8. That means AFRM will continue to move up. Currently, the stock price is $20. And you are telling that I am okay to buy at $18. If the stock goes down, I am okay to buy $18, and you are collecting the credit of $2 for December 2nd. So you can see that stock is at around 20.3, and there is a high implied volatility, right? As a seller, if there is a high implied volatility, that is advantage for you. That means they are paying a high premiums to you. So the chances of the stock to move up is much more higher, because they have earnings call on 8th November. People will be more and more interested to buy the stock now until 8th. After 8th, based on the news, if they have good earnings, it can move much more higher. If they don't have good earnings, it can go down. But we don't need to wait until earnings call. One day before earnings itself, we can close with some nice profits. So what you are selling a $18 put, saying that if stock comes to $18, I am okay to buy from you. And how much you are collecting? $200 for every contract. That means your price of the stock is becoming, right now it is 20. You are telling them that $18, if stock comes to 18, I am okay to take the risk and buy the stocks from you. And you are collecting $2. That means your break even is $16. So what is the possibility of the AFRM becoming 16 before earnings, right? By earnings, already this IV will keep on increasing. You collected the premium and you can make nice profits, right? You don't need to wait until December 2nd to take profits. You can, right? If November 8th is the earnings, before earning call, you can close with nice profits on it. Like that, there are so many tickers where we can make profits before earnings, right? Again, because why earnings? Because earnings is the time where people will be more interested to buy the stock, because of assuming that okay, they may give good earnings. Because again, as you know, AFRM, another good stock which was like 176 $180, now trading at $20, or it was much more. I think even it moved about $200 also. But again, right, it is at a discounted price. If I want to buy AFRM, instead of directly buying the stock, I will sell a put, I will collect the credits. If stock is staying above 18, all that money is mine. If stock goes below 18, until 16, it is break even for me. If it goes below 16, where the possibility is very, very less before earnings. So instead of buying it at 20.3, I can sell a put, collected the credit, and if stock is still above 18, then all that money what I collected is my profits, right? So that's what, if you want to buy SOXL, you want to buy TQQ, you want to buy AFRM, you want to buy CVNA, you want to buy Tesla, you want to buy AMD, NVIDIA, instead of directly buying a stock, why don't you sell a put? And if that stock is not going down, all that money is yours. If stock is going down, you are getting the stock at a discounted price. Instead of buying now, you may wait for 1 week or 2 weeks, and then you may get the same stock at a much discounted price. Right? That's the concept with cash secured puts, where you can now, right? It is again another low risk or a good strategy on good stocks, right? Again, you don't buy on some unknown stocks, but anyway, if you are planning to buy a stock, then sell a put, and then if stock is staying its same price or stock is moving up, all the credit what you collected is yours. If stock is going down, right, still you will buy a stock, but you may buy it at a much lower price. Right, I hope everyone got it. So these are AFRM, UPST. There are many examples which are looking good based on the IV, based on the price, what is the current price. And again, you don't sell too much out of the money, right? If stock is $24, if you try to sell a 15 put or 16 put, you may not get much credits, right? So it should be somewhere around 15 to 20% away from the current price, so that your risk is minimal. And if you immediately try to sell for the next week, you may not get much commissions. So generally look for 30 days away from the current date, so that you get a better credit. And before earnings, because the IV is huge, if you don't want to take the risk for earnings, just 1 day before earnings, on the earnings day, if earnings are after the hours, just close, so that you can collect majority of the premiums by selling the puts. Right, another strategy which I want to share is the covered calls. Again, covered calls is also another great strategy for earning season. Right, again, if you are totally a new trader, it might be right, too much for you. But if you are an experienced trader, if you know, then all these strategies are good for this choppy market, or right, in this market where if it is a right, a bullish market like 2020 2021, then doing calls and puts is the best way, right? Because generally it goes in one direction. Either stock will move up, it goes to a resistance, again it will come down, again it comes to support, again it will start moving up. So at that point of time, just if we do calls and puts, you can make good money just by calls and. But now we are saying that market is completely news driven, and completely it goes up, again it comes down, again it goes up. So these are low risk strategies where you are avoiding the risk, and you are instead of as a buyer, as a seller, you have more potential to make money in this market, right? So what do you mean by covered calls, right? It is similar to secured puts, but instead of selling a put, you are selling a call here, right? Again, let us say you bought a house in Austin because you thought Austin market is very good, market is going up, you bought a house. But suddenly market, right, the house prices went down. Then what you do, you don't keep the house just like that, right? You will rent out the house until you see that market is again going up. In the same way, we all might have bought a lot of stocks. You might have bought Apple or AMD or Nvidia or Tesla or some various stocks. Instead of, you know that market is not good, market is going down, many stocks went down, but instead of just keeping those stocks like that, we can always collect the rent on those, right, by selling the calls. You already have stocks in your account. Let us say you have 100 stocks of AMC or AMD or Nvidia, whatever it is, you can just sell a call and you can collect, right? Somebody is assuming or expecting that stock to move so high. So instead of he buying the stocks, he is just paying a premium so that he can make profits by buying a call. So you can sell him a call, and if, let us say you bought a stock at $20 and you are selling a call for $24 and you are collecting the premiums, right? You already have a stocks in your account. Instead of keeping them just idle, what you are doing, you are selling a call for 24. That means now what you are saying, even though stock goes to 30, stock goes to 35, I am ready to sell the stocks at $24 to you. By selling a call, you are committing, you are obligated to sell the stocks at $24. So your profit level might be reduced, but you are collecting the premium by selling the call. Now, if stock goes to 22 instead of 24, all the premium you collected is yours. If stock goes to 23, it is yours. Stock stays at 20, all the premium you collected is yours. Stock goes to 24, all the premium you collected is yours. Even if stock goes down, right? Anyway, you have your stocks are sitting there in your account. Instead of keeping them idle, you keep collecting the premiums. Again, 1 month over, next month again you can sell the calls. Again, collect the premiums. If stock moves up, so you bought at $20, you are selling a 24 call, still you are making 20% profit. You are also receiving the premiums by selling the calls. So you are making profits in both the ways. Again, let us take some examples, right? Let us take, you bought a stock, something like AMD. Let us assume you are buying AMD stocks, $62. You are thinking that, oh, AMD was sometime like, it's like a $200 plus stock. Now I'm getting it for $62. Let us say you bought AMD stocks at $60 or $62. Now, instead of just keeping the stock like that, you know that earnings are coming. There will be a lot of interest for people. You can buy a call or you can just sell a call for 65. Let us say you are selling a 65 call, right? Earlier is you sold a put in the cash secured puts. Now you have the stocks in your account. So you don't need any other collateral. You already have stocks. So the brokerage platform knows how to collect those stocks from you. You bought 62 AMD stocks at $62. You are selling, right? For after 4 weeks, you are saying that I am okay to sell the stocks at 65 to you, and you are collecting the premium. So if stock goes to 61 or 60 or 59, that means whatever premium you collected, all that premium is yours. If stock, right? If stock is 62 or 61 or 63, 64, 65 or 60, 59, whatever it is, whatever premium you collected by selling the call, all that money is yours. If the stock goes above 65, still you are making a profit because you collected the premium, you got some cash from the option contract buyer, and also the stock moved above 65. So you bought at 62, you are selling the stocks at 65. There also you have a profit. So you collected money from premium, you are also collecting money from, you are also making profit on the stock difference. So in both the ways you are making profit. right? Stock rose $3, so that is a $300 profit. And also you collected some premium by selling the 65 call. Whereas if it is exactly at 65, you are right, 65 or below, you are also making profits. If it goes above 65, you collected $200 as a premium for selling the call, 65 call, and you bought at 62 and it went to 65, that is $3 per stock, 100 stocks, $300, you made a profit. So in how many ways you are making profit, right? If stock is going down, you are making a profit. If stock is up to 65, you are making a profit. Even if it goes above 65 also, you are making a profit. Only, right? Only risk is if it goes so much high, right? If it goes to, suddenly AMD goes to $80, you might feel that, oh, I just got only a small profit. But in this market, even making profits or preserving our capital is a lot more important. Instead of just blocking the capital, blocking all the stocks, you are selling the calls and you are making profits, right? That is the advantage with covered call strategy, especially before earnings. Again, you know that there will be a lot of demand. There will be people ready to buy the calls, right? You might be thinking, who will buy calls, right? Why they will buy calls? There are a lot of people, right? There are all the retail traders generally, they want to buy calls or they want to buy puts. So if there are earnings for AMD, Nvidia, you can buy the stock, right? If you're interested to buy the stock, instead of just buying the stock and sitting idle, you keep selling the calls. You can collect nice premiums now because there is high implied volatility, there is high interest, so there will be a lot of liquidity now. So this is the best time to make money by selling the covered calls. Again, right? I am giving some examples, right? For example, AFRM for December 2nd, right? So now what is the stock price? $20.3. I can sell a 30 call, right? The current stock price is 20.3. I can sell a 30 call. That means I am telling that I am okay to sell you the stock at $30. If I buy 100 stocks of AFRM today or on Monday, I can immediately go and sell a 30 call for December 2nd, and I can collect $68 as a premium. Let's go here. AFRM, right? If you look at 30, right? Current price is $20. What is the possibility of this going to $30 within next 4 or 5 days or 6 days, right? Before earnings, what is the possibility? The possibility is very less. So let us say you have 100 stocks of AFRM. You can sell one call and you can collect the $70 premium. And if stock is going above 30, then, right, you are making 50% profit with your stock purchase. You are also making profits by collecting the premiums, right? If you have 1,000 stocks, you can sell 10 contracts. That means nearly $700, right? It is like collecting the rent. In this month, let us say the stock is not reaching to 30. So all that $700 you collected is yours. Next month, again, you sell another 10 contracts. Again, for example, it is not reaching to 30. You got another $700. Just like you bought a home and collecting the rent each and every month, you can look at these good stocks where you have good premiums, right? They should not be very close, right? If you just sell a 21 call or 22, immediately the stock might go to 24, 25 before earnings, and you may have to sell those. So again, if you want to keep those stocks, you can just keep selling something, right? Or, right, if you think 26 or 27, again, you see $7 implied move. That means this stock can go to 27 or something by end of this week or by end of 2nd December. There is a possibility of, there is a high implied volatility. That means by selling, you can make good profits. As a buyer, you are paying for the implied volatility. As a seller, you are collecting the implied volatility. So as time passes, as a seller, you are at a benefit. With the high implied volatility, you are at a benefit. So you are buying 100 stocks of AFRM immediately, instead of just keeping and waiting for AFRM to move up. you can sell a 30 call, right? Earlier, what we did, we sold the puts in the cash secured puts. Now, if you have stocks in your account, you don't need any other collateral. You are just selling the calls and you are collecting the premium. Only if stock goes above $30, you are at a loss. Otherwise, if stock is only staying up to 25, 27, 28, even 30 also, you are at a profit, right? Even if it goes to 30 or 31, you got a $20, that is a 50% profit. And in addition to that, you also collected the premiums. All that is yours. So you are making profit in both the ways, right? So we need to look for which stocks got earnings and just buy 100 stocks of that, which are at a reasonable price, nice, good price, and then keep selling the calls and keep collecting the premiums. In both the ways, if it doesn't reach to 30, all premium is yours. If it reaches to 30, also you are making profit by the stock increase and also by collecting the premiums. In both the ways, you are making profit, right? So let's see one more example, right? For example, AMC. What is the current price for AMC? It is $6.4. And what is the earnings? Earnings is on 11/8. That means there will be huge interest, huge demand for AMC. So you are buying a stocks at $6.4. And you know there is a high implied volatility for AMC generally. You can sell a December 2nd call, 10 call. That means nearly 50, it should increase more than 50% to reach to 10. If it is not reaching to 10, then you basically make all that credit, whatever you received, all that credit is yours. If it is above 10, then you are making 50% profit on the stock price. And also you received the premiums. So like this, we can look at which stocks got good premiums, which are the best expiry dates, for which we have earnings, all this, right? As I mentioned, we have a bot which will be tracking all these hundreds of stocks. It will give us the best time or best strike price, which price to buy, where there is a high implied volatility, where we can sell it, so that we can, right? Again, we don't need to wait until the end of the earnings. Even one day before earnings, we can make good profits on it, right? Again, the profits may not be huge, but 20%, 25, 30% profit is also good by taking a low risk. Your stock is at 6, you are selling at 10. Only if stock goes above 10, that is also not a risk, right? If stock is going below 6, minimum you are collecting the premiums. That means your stock price is going down. You collected $26. That means on your $64, or right, whatever you are collecting the premium, your stock value is, right, basically your cost price is getting reduced because you are collecting the premiums every 2 weeks, every 3 weeks. You are selling a call, you are collecting the premium. That means your investment, it is like right, your investment is getting reduced because you are getting some returns. Instead of just keeping it idle in the account, you keep selling the calls and you keep making profits. Again, right, same thing. Whichever stocks you want to really buy, you buy those stocks, then you can keep selling the calls and you can make nice profits in the earnings season, especially with earnings season. Why? Because there will be high implied volatility. So you can make, there will be huge interest before the earnings for buyers to buy calls or to buy the stocks. So that's why earnings season is the best time, where you can do covered calls, you can do secured puts, you can do iron condor, you can do straddle, you can do credit spreads. All these are various strategies where we can, with a low risk, right? As a buyer, you have only 1 out of 5 possibilities to make money. Whereas as a seller of a call or as a put, you have 4 out of 5 ways to make money. So which one is better, right? We always look for probability, right? You have 80% chances to make money as a seller, you have 20% chance to make as a buyer. So which side you want to be? Again, right? Nothing wrong to be on the buyer side, because if it immediately moves, as we expected, you make nice profits. Within 1 hour, 2 hours, you can make 40%, 50% returns. But if not, if it is not moving as expected, then all our premiums will become zero, right? Suddenly, right? Because of implied volatility, time decay, all those reasons. But as a seller, all those are helping you. If the stock is not moving, that means you are at a benefit. If there is any extra holiday, that is at your benefit. If there is a weekend, that theta decay is helping you as a seller. So as a seller, you have a lot more advantages. Only thing is you need to have a bigger account as a collateral, or you need to have the stocks, all those things. So, but again, instead of having money just sitting in the bank account without making 0.5%, 1%, use these low risk strategies and we can make 15%, 10% returns also, profits also by taking a low risk. Again, not every trade may not make money, but if 9 out of 10 make 20%, 25%, even if we lose on one trade, will be still profitable at the end of the day. So again, right, our right, we'll be sharing in our channel, in our premium channels, these uh, covered calls and spreads, and also iron condors, right? Because many of them don't know about many of these strategies. Generally, they only buy call or buy put, but they don't think from the other side that they can also sell and make profits in with a low risk, with a much higher probability, right? That's why, especially earning season, these are some great strategies where we can make nice profits. So that's what I wanted to share today about all these strategies like credit spreads, and then iron condor, straddle, then covered calls, cash secured puts. We discussed all these various strategies where the risk is low, right? There is no strategy in trading which is 0% risk. But the risk is, instead of taking 70% risk, here you are taking 20% risk. You have 80% of chances to make money when you do any of these strategies. Whereas with calls, and so again, it based on your risk profile, right? If you are a high risk tolerance guy, you are okay to take huge risk to make huge returns, just buy calls or puts. It is up, right? You can do that. Nothing wrong, right? Or you want to take low risk. You are happy with 15% gains, 20% gains. Then these are some of the strategies which you can use, and these strategies work much better in the earning season because of high implied volatility and huge liquidity and huge interest among the traders to buy stocks, buy option contracts. Right. For covered calls, you need to have stocks in your account. Right. Selling a naked call is always risky, because if suddenly stock moves so high, then again you have to pay huge. But yeah, covered call, you already have stocks in your, right? It is like you already bought a house. It is just idle. The market is dull. So instead of just keeping it idle, you are renting it out. In the same way here, you are selling a call. That's why it is called as covered, right? It is not a naked call. It is a covered call, because even if stock goes down also, you don't need to worry. If stock moves so high also, you don't need to worry, because you have stocks in your account. Yeah, for doing all these spreads or covered calls, generally you need to change to level 2 or level 3. Generally it is level 3 for spreads and other things. You can call the customer support of the brokerage platform and they will change it, right? If you tell that you know about all these things, you have experience, they will change it to level 3. You don't need to prove anything. If you tell them, and then they will change it to level 3, and you can do these things. Yeah, for covered calls, you need to own the stock, right? You can sell the calls even without having stocks, but that is a very risky. right? Suddenly AFRM suddenly goes to $40, right? When you have a stock, you already bought at $20, even if it moves to $30, you are still at a profit because you already bought at 20. But if you don't have a stock and you are selling a call of 30, suddenly because of some, let us say Amazon want to buy AFRM tomorrow, and suddenly next day by the morning you right get up, you see AFRM at 40. That means you have to sell the call, right? You have to um, sell at $40. So right, that might be a huge risk where you don't have the stocks in your account. That naked calls will be a huge risk. Right. I think many members has the same question. Should you have the stocks? That is the reason. If you sell a naked call and stock suddenly moves, you will be at a big risk. Right. When you are selling a put, you will sell at a lower price of the stock. When you are selling a call, you will do the opposite side. Right. If your stock is at 20, right? For example, AFRM stock is at 20, I am selling a 30 call. AMC stock is at 6.4, I am selling a 8.5 call. So, right, this is DKNG, it is a $15. I am selling a 19, right? Again, I'm looking when they have earnings and I am selling it for a future date because I know generally between this will, right, before 11/4, the stock will fall somewhere in between 15 to 19. So I can collect all those premiums. American Airlines, the stock is at $14. I can sell a 16 call or something, and I can collect all these premiums. Yeah, for secured puts, suddenly if the stock goes right, let us say there is some bad news about a stock, and if stock goes to zero, right, where the chances are very, very rare, out of thousands of stocks, we may see one or two instances like that. But even if stock goes to, for example, right, again, if you go back to this example, cash secured put, you are selling a right Carvana put for 12.5. The current price is 14.5 or 14.475. Suddenly if stock goes to $5 tomorrow on Monday, but still you have an obligation to buy the stocks at 12.5. But what are the chances? It is a $200 stock now trading at $14. They have earnings. So the potential for the stock to go to 15 or 16 is more. What is the possibility of that stock to go to 12.5? That's why we are saying there is a, right, that additional 10, 15%, 20% risk, right? We can never assume that it will be always above 15. There is always one or two cases which may happen like that where, so that's why, right, always maintain that position size, right? We should not feel that, oh, like, let me put all my money on CVNA, right? That's what generally we try to do. We want to quickly become rich and we try to uh, put all 50% or 60% or all the money in one trade, and suddenly if the trade because of some reason it goes against, we'll be losing huge. But if you put 5%, 5% in 20 different trades, even if one or two trades doesn't go in your way, other 18 trades will make you money, right? As long as we have that patience and we are okay to take time to make profits, then we'll be in the profitable situation, right? Maintaining that position size maximum 4 to 5% of your account. That's the right way to, right. Once you make 2 or 3 profits, we tend to go big on the next trade, and the trade may go against us. So that is one important thing which we all need to, right. We all those emotions play, and we need to maintain those emotions and try to be on the profitable side. But again, right, I tested these strategies. I tested the bot. They are working really good. 90% of the time, they are giving nice profits. And I will be sharing some, right? I will be sharing all in the premium channel and a few sample alerts in the US equities. So you can test it out, and then right, you can, once you get confidence, you can take in your accounts, right? But again, right, because market, we don't need to be away from the market, because we never know when market will reverse, when it will turn to bullish. There are always some strategies or other for every market. We need to play based on the market situation. We need to change our strategies, and these strategies are working good in this market, and will continue to make nice gains using all these strategies. So with that, again, I don't want to take more time. We are already more than 20 minutes, but yeah, thanks everyone for joining, and I hope you learned some nice strategies. And yeah, try to, again, don't buy them on some unknown stocks. If you are buying a secured put or covered call, take them on ETFs or stocks which you are anyway you want to buy, right? Anyway, if you like to buy CVNA or SYXL or AFRM or UPST, instead of just buying it, sell a put, so that you get that SYXL at a much discounted price. If stock keeps going up, all that premium is yours. Whereas covered call, you already have a stock, and don't use covered call for high momentum stocks like GameStop or something. Generally use them for some stocks which are not very, they don't move very huge, right? I just gave AMC as an example, but even AMC also not a good candidate for covered calls, right? Stocks like DKNG or American Airlines or AT&T or Verizon, they don't move much. They generally stay in the same size. So for such type of stocks, selling covered calls is always good. But we'll be sharing right, various alerts, and we'll be sharing how they are performing. So you're right. Yeah. Thanks everyone, and have a nice rest of the weekend, and happy trading. Be on the green. Good night, everyone.